Well, I hope you all rushed away, got yourself some lunch, and managed to get a cup of tea or a glass of water, because next up we have Hedley Widdup from Lion Selection Group. I've known Hedley for quite some time. He understands the resources industry extremely well. Today, he's going to talk to you about what you never get told, what investors never get told. But here's something you also never get told. You know, sometimes, just occasionally, Hedley tells me that he unpacks the dishwasher. So that's just a shout out to all you blokes out there. Do you unpack the dishwasher? Hedley, good to see you in lockdown, lock up Melbourne. Here we are back on Zoom again. Wonderful to see you, my friend.
Hey, Kerry, it's nice to see you as well. And thank you for inviting me to present virtually to the Gold Conference, like you said, in lockdown. And this is my one phone call. So here we are, me getting out into the world. It's wonderful. Really appreciate it. And thank you for the introduction. I do empty the dishwasher. In fact, I do it all the time at home and quite a bit of the time at work as well. So, you know, people talk about one of the differences between small companies and large companies is that in small companies, you've got to be able to wash your own coffee cup. And I don't know where we stand there having our own dishwasher. So, you know, maybe we're big, maybe we're small. I'm working with a brand new template as well. This slide template is just being rolled out by Lion Selection Group, and this is our opening slide. I'm not going to talk about Lion Selection Group today. I'm going to talk about the sector, but what you see in the cutout of the lion in the background here is a hill in northern Indonesia, and it has, well, on the face of it, it has about 4.7 million ounces just sitting within that frame of view. I think it's probably somewhere more like 8 to 10 million ounces.
Wow.
So there's a real good watch this space to come on that there. Anyway,
Hedley, you can't just say that and then not tell us what's the company that's got that land that's got 4 to 8 million ounces of gold.
The company that's got that land is Lion Selection Group, and it trades on ASX under the ticker LSX. And we have a joint venture in Indonesia with a leading gold company called Merdeka. They're a gold developer, so we sit there getting well, not brought along for the ride. We're investing our way, but that project will hopefully come to fruition within a very short period of time.
Okay.
Yeah. Anyway, tantalizing introductions aside, so this is for the benefit of everybody watching, Kerry. This is the topic that you gave me. What investors never get told, but should, or they might get burned. So about 3 weeks ago, when I started working on this presentation, I got out my brand new template and I did the title slide, which was easy because it was already there. And then I did this slide, and then I stopped and I thought, oh shit, what do I do now? So I thought at any one time in the cycle, you know, depending on what the commodity prices are doing, there's all sorts of things I think that you never get told, but what are the best ones for now? So I scratched my head, and this was like 2 weeks of thinking, probably to think through what are the most topical things to cover off today. And I came up with these 3 things, and they're timely, they're topical for now, and particularly for people who invest in the mining space, and in particular in that with junior companies that are either exploring or developing a project or have one project which they're operating and producing from. So we'll explore these as we go through the presentation today. I deliberately sort of thought of provocative titles, which might not be self-explanatory. Well, it's good to, you know, keep listening because I will explain what each of these means. So, well, I'll start off with people, and this is the problem with people as far as how they interact with investment markets. And this is a quote. I should have tagged this. The person who says this probably 3 or 4 times a day is my father, who I work with. People will pay far more for something that they don't understand than something that they do. And this is, I mean, you know, this explains volatility right there. But it's really topical for mining enterprises. And you think about any company that you can invest in the equity market, and try to pick out the ones which it's most easy to willfully misunderstand. I mean, mining companies deal with geology, and exploration companies especially. But then there's the overlay of commodity prices, which are unpredictable. But, you know, from the point of view of an investor, they're difficult to decipher. So the value equation is extremely difficult to come to, and often they don't. Most of the people we're talking about here that overlay the volatility on the small sector are probably not investors per se. They're far more speculators. So this is the first thing, right, that I think people who want to invest in this space need to be aware of, is that everybody else that you're running around in the playground with here are probably going to have a slightly different approach to it, and it's just worth understanding that. Let me put a couple of pictures to that. So here's what I think some people call this the Lassonde curve. I would attribute it differently. Pierre Lassonde was the boss of Newmont for some time and coined this curve. I think there's been others as well. Robin Widdup, my father, has coined this one as well, probably from the reasonably similar point in time. It doesn't matter who thought of it. I think a lot of people understand what it means. And this is the evolution of value that exists within a mining company. If you present that they start from the point before making a discovery, and the end point on this chart is they're producing from the project which they discover. And on the way through, let me see if you can see my cursor.
Yep.
On the way through, they find something, they make a discovery. Value goes up tremendously. They start making an assessment, go through feasibility studies. That value, or price, probably more in this case, comes back down, and then they eventually sort of equilibrate at a point which reflects the cash flow that they can produce. So there's an overshoot, there's an undershoot, and then it more or less oscillates around what probably reflects their ongoing cash generative abilities. Risk falls away as you go, but the point of this chart is that you could probably, arguably, if you were an intensely sophisticated investor who can do mining project studies and overlay correct costs, once the drilling is given a shape to it, which is going to be part way up this leg, you could say value is known, and the value shouldn't change too much. It'll be subject to commodity prices from there. Now you're going to say, oh, you might be wrong here because we find out about the costs as we go down this side. Well, that's correct. That's because the company tells us what the costs are. So I'm just arguing that the true underlying value here could be understood earlier in a truly sophisticated sense. There's a lot of hard work in that. But what does happen is that as there's a lot of good news happening, discovery holes, extension holes, it's getting thicker, it's getting higher grade, you name it, the share price just keeps going up. Value has got zero to do with what people pay in the discovery phase, because there's always a potential. We could go along strike and double this thing, right? You come out of the discovery phase and you start doing things like feasibility studies, and people go, oh, recovery is not nearly as exciting as a discovery hole.
And sorry, Hedley, to interrupt you there, because we do have people on the conference today that don't understand what even feasibility means. And that really, if I understand it, it's the economics of the project. It's putting the numbers around it to see whether or not it's economic to dig the gold up and make money from it. Can you explain that better?
You got gold in the ground, or it could be lithium, or it could be copper, it could be any commodity you want. It's been defined by drilling a bunch of holes in it, which tells you where it is in space, how thick it is, what grade it is, so what concentration within that thickness, whether that's high or low, and how deep it is as well. I mean, sometimes these things are close to the surface, sometimes they're not, and that all has a bearing on how much it's going to cost, not only to set yourself up with a processing plant and infrastructure to sell, but also for the ongoing costs of extraction. Is it going to be a high cost mine? Is it going to be a low cost mine? Should it even be a mine? And that question, sadly, sometimes doesn't even get answered until you get to the point of early producing. Sometimes, I mean, it's not uncommon for people to fall in love with a project, and this happens in big companies and in small companies. Not just a figment of the junior space where people need a project to work for it to be their viability. It happens in big companies too. So you go from the excitement of discovery into the fairly unexciting feasibility or study phase, and there can be a number of studies which take place in that process. And typically value undershoots, because the thing which you're marching towards there is, we're going to have to fund this. How are you going to do that? At this point, I don't know, pick a number. You could be capitalized at 500. In fact, there's a company on ASX at the moment, Kerry, which is still exploring, which is capitalized at $3 billion now.
$3 billion.
I don't think they're going to have a problem funding their project, but nobody knows what the cost is going to be to fund their project at the moment. They're just exploring, and they're still going out along strike.
Wow.
The first time a pure explorer has been included in the key indices. I can't remember whether they've made it into the 100 yet, or certainly in the 200.
Yeah, I think I know who you're talking about.
I'm not wanting to rubbish a company there by identity. Hence the reason not to name it, because it might seem I am. The point is, these things can go. They can really get exciting, right? But then you get into the feasibility, and excitement might fall away. So you undershoot. And then you've got to fund it. How much money are you going to raise? Oh, they're going to raise money. And that often takes the heat out of a share price. So, there's human emotion involved in all of this. And that's the thing. So if you're sitting there trying to value a company or thinking, what should I pay for this? You've got to understand what the market cap is. And even if you don't know what the project should be worth, you can sit there and go, well, okay, I've seen a few gold projects in the time that I've been looking at them. And I know that high grade is good. And I know that thick is good. So if this is something which is 2 meters thick and it's grading 1.5 grams and it's 100 meters deep, should I be paying $400 million for it? I think the answer is no. Whereas you might be in the mindset that, okay, they've hit something at a depth, maybe they can trace it up. There's a lot of unanswered questions. Would I pay $10 million for that in the market cap sense? Okay, we'll take a risk, but at least you're not paying a hell of a lot for it. So, you've got to understand that, am I taking a big price risk, and what stage are we at here?
And do you think, Hedley, that in the current environment as we sit today with a lot of social media around, that a lot of people are speculating and just taking massive risks by listening, I don't know, to somebody talk on Facebook and say, oh, what do you want to invest in today? And it goes back to your initial point, they've got no idea what they're paying for.
Yeah, look, I think that's true. And at the moment, it's easy to say that social media is one of the things that really lubricates that. And it does globally. I mean, we live in a global age. So the community which we work within now is by its very nature global and 24 hours. But speculative booms are not a new thing. If you were to, in fact, anyone who has a bit of a historical interest should read Jeffrey Blaney's book, The Rush That Never Ended. And he talks about a range of booms. I mean, when there was gold discovered in Victoria, all of a sudden stock exchanges popped up in Ballarat and Bendigo, and even smaller towns now. I mean, we think about them having a population of 10,000 people now and think, well, how on earth could it have supported 25 breweries and a stock exchange? But the fact was, at that point, when there was gold being discovered, money was pouring into those regions, and where money goes, speculation follows. So, there was loads of exchanges which have all come together into, well, in Australia, it's aggregated mostly into ASX, but similar things in other markets. There are singular focus exchanges, which previously have been jurisdictionally spread, and I think that there was booms in the early Victorian discovery. There was then a boom when Broken Hill was discovered and silver shares in New South Wales became speculative, and on it went. And this, boom circled Australia. And it wasn't necessarily points in time, it was more points in geography as it circled the Australian map and ended up in Kalgoorlie. And then, of course, there was multiple exchanges that were set up, Coolgardie, Kalgoorlie, as those discoveries were made and then progressed into mining jurisdictions. So the social media effect makes it global, but at the same time, that same thing, people without phones standing outside on the pavement in crowds of 100 people or more could still spread those rumors, and they did. It's just the form that's changed. Second example then of the way that people are prepared to pay for something that they don't understand. This is commodity price interaction, right? But using a fairly large and broad index here, ASX 300 materials off ASX, and the red line, which is overlain, is the price to equity, price to earnings of that index. And the shaded spots are mining collapses that we've had in those times. And all I want to really point out is that speculation creeps into this index early in cycles. So things have got to a point which is bad. There's probably a 6 to 12 month period after the return of sentiment, if you like. It's very early and tentative. But when people start to think, okay, I can pay a bit more for miners now because I think commodity prices are going to go up, and the price to earnings spikes because earnings are lumpy. They don't come along until afterwards, but people are prepared to pay before they get there. And that might be a bit more sophisticated. It's not like trying to understand mining costs or anything like that. You're applying this to miners, but anyway, it's another example. So I suppose the thing to remember is that volatility in prices of anything are caused by people. If you take people away, there's no markets. So the volatility comes from people. And if you're going to invest or buy shares in anything, you've got to understand there's other people involved who will change that price. And you need to be aware of maybe what sentiment is driving them and the emotion which comes into that. So moving along, the second thing I wanted to talk about is that some margins never change. Now, this expression is just modified a little bit from some people never change, and I'm talking. This is another one which is topical now, because the first one was topical. Explorers are getting really hot and frothy. The second one is topical because we're seeing commodity prices move, and we're seeing that across the board. We're getting into windfall territory for a number of commodity spaces, and with that comes the assumption. I mean, we know that commodity prices go up. We know they come down too. So I'm speaking about this strictly from this point in time perspective. The ignored fact is that when commodity prices go up, costs usually do too. And it's operating costs to an extent. It's the things you need to spend to keep yourself in business, and it's the opportunity investment of building for the future, which is often a bit more about empire building than necessarily keeping in business. But this is something I thought we'd explore, and I realised as I was rehearsing this earlier, Kerry, that I might have a few things in the wrong order here, so I might just chop around with my discussion. But what I'll start with is an example from the Australian gold sector. So here's 20 and a half years, although you can't see the time frame just yet, of the US dollar gold price. So I think a lot of people who invest in this space are probably familiar with this chart. It went for a real ball-tearing run from 2000 right through to 2011, leveled off a bit, came off, and now we're touching those highs again. What I want to add on for the Australian Gold Index over that time, here are their operating cash flows, and an operating cash flow is just revenue. So gold sold minus your operating costs. And the purists here are going to go, Hedley, operating costs, what does that include? What does it not include? It doesn't matter. All right, we're going to get to that. Over time, the way that operating costs have been reported has changed here as well. But I don't think it makes a tremendous amount of difference to the shape of it, because what I wanted to point out is that, operating margins, which is exactly what we're seeing here, is the amount of cash which is left over when commodity prices go up, has definitely gone up when commodity prices do. But this isn't where it ends, because you forget about how things are classified in a reporting sense, in a cash flow sense. You haven't got to the point where you can say this money is in the shareholders' hands until you've taken care of your investing activities as well. So let's add those. So these are the investing cash flows. And the interesting thing about these is that they're just the mirror image opposite, if not, one of those, the circus mirrors that make everything fatter or bigger or taller. Yeah, so it's the circus mirror. It's made everything taller. So the investing cash flows, and these are often the invisible ones, because when companies report their cash costs, and in the gold sector, it's cash costs and then all in sustaining costs, you're missing material from below this line here in many cases. Now, there's a bit of the sustaining capital, there's royalties in all in sustaining costs, but if you say, okay, let's build something new over here, that's going to be capex, not sustaining capex. It's going to be, let's go forward and treat this as something different capex. So it happens in a sense which is reported differently, and this is always really useful to look at. And I suppose the point of just have a think, if you report on an annual basis, there would have been years here where the industry showed a good margin. There definitely would have been, and in fact, I think probably the windfall years there where gold price jumps up catches everybody unawares, so you make a bit more money then. They're probably the better years in terms of just putting money aside. If the gold industry in Australia had to report on a 20-year time frame, here's what it would look like. Oh, what have I done? Oh, I've just put on the aggregate. So the line I've just put is operating plus investing cash flows. Shows you how much you've got left. If you report that over 20 years, right? So if this was a 20-year annual report, the Australian Gold Index would have to say, in 20 years, we've generated almost $50 billion of operating cash flows. Wonderful. In that time, the gold price has gone up most of the time. That's also awesome. But then they'd also have to say, we've invested $60 billion. So you actually end up with not a lot. The top minus the bottom is a negative number.
Yeah.
Now, I'm not trying to make the point that the Australian Gold Index has been a rubbish place to put your money, because it's been a really good place to put your money. The equity value has gone up, and this is not certainly where the assessment ends, because what they've invested in is reserves in the ground now and production capacity into the future. You've got to consider that on any basis when you look at this. And of course, you look at it quarterly or even annually rather than on a 20-year basis. The point is that with all of this commodity price windfall, which they've been delivered, the margin actually hasn't gone from little to very, very large. The margin has probably crept up, if anything, with the price as costs have increased and as investing capacity of the company and their willingness to spend money has also increased. And that's what you can see from my bottom chart there. So the point is commodity prices provoke investment, not necessarily windfall profits. And I suppose just to close off that chart, 2020's numbers, which is the most recent I've got on here, we saw an enormous jump in investing in the Australian gold sector. Now, what that comes from is there was two companies, which are now one, which purchased an enormous project in Kalgoorlie from the Americans. And you can say, well, is that an investing cash flow? Genuinely, it's been M&A. That's correct. It has been an M&A exercise, but it's also been an investing cash flow because they had to purchase those mines. And what comes next with them is more capex. I mean, there's a discussion there about going underground, which I think is very exciting. There's also a lot of capex to come with it. So the Australian gold industry is poised to invest. I mean, we're seeing the Cowal underground becoming a thing in evolution as well. So you think of the two big pinups, I'm excluding Newcrest, they've got capex all of their own as well. So these companies are gearing up to invest, not to provide steady dividend streams. They will, but their eyes are on how they make themselves bigger and longer life.
Well, actually, Hedley, we've got Jake Klein talking later today on what they're doing at Lake Cowal and others. And as you say, there's a lot of operating costs right now, which possibly puts a bit of pressure on the share price. But actually going forward, it looks to be quite a solid company. Well,
or to segue into evolution for a moment, and even Northern Star, which I mentioned without mentioning them before. Both of those companies have had wonderful evolutions over the last decade or so, and have been, I think, probably the strength of the sector in that they've set the way, not just in Australia but globally as well. They've really set an example for managing your cash flows and investing. Treating gold production as a business, which I know sounds like a strange thing to say, but making sure you have a positive cash flow at the end of the day, as opposed to what had historically been the norm. So I think the investments that they're making there, and also the progress they're making in North America, is really exciting for evolution in particular. So so hi to Jake.
Yes, well, as I said, ladies and gentlemen, those comments on evolution, Jake Klein will be presenting later today. So stick around for that one.
I'm going to jump out of the gold sector for a second, and here's where my slide order should probably have been just changed around a little bit. But I thought I'd just point to dividends from the two largest miners, BHP and Rio Tinto, because these paint a picture. And I was talking about operating cash flows and investing cash flows before. I did have charts on them as well. It's just that was outside of gold. And here is a thing which happens after investing cash flows have taken place, which is that the company will pay dividends if they're able to. And so I've got BHP on the left, Rio on the right in their corporate colours. And then if we put on the two major commodities which pertain to both of these businesses, copper and iron ore, and again you see that the commodity prices produce spikes in the dividends. So in these companies' cases, they pay dividends, and in which case these dividends become a good indicator of how things are going for them. And these companies have wonderful cost structures, so they can afford to pay sustainable dividends. So you can see that you get into windfall territory there, and dividends jump up as well. But just looking at the aggregate dividends, which we have on the screen here, you sort of say, oh, it looks like it's falling off a bit. In which case it's worth breaking them down, which is what I've done here. So you've got interim, then annual, and then special dividends on top of that.
Right.
And the interesting thing about that is that the 2021 dividends for both of these companies are only the interim. So the final and probably another special is yet to come. The jump that we've seen in iron ore prices and copper prices is going straight onto the bottom line for these guys. They haven't had time to reinvest any of that money. So it pops through as dividends there, and we're seeing a fantastic spike.
But just to be clear, Hedley, it's BHP on the left as you're looking, and Rio
Correct.
on the right, ladies and gentlemen. And
That's right.
it looks like Rio is paying a better dividend if I'm just looking purely as what the payout is. So
well, their cents per share, and you've got to make that relative to their share price.
okay.
And so it's really, I didn't want to map this as being anything that's a comparison between the two companies. What
Okay.
I wanted it to show, and remember, I'm talking about how margins, stay maybe not static, but they don't expand nearly as much as you think they're going to in time. And I thought, here's a way of trying to disprove my theory there that these companies, will pass it all through to shareholders. And in the last 4 or 5 years, BHP and Rio have actually pushed a lot of money into dividends here, which perhaps maybe it would, maybe it wouldn't. There's a point on both of these charts. Draw your attention to 2016. Now, for anyone who's a student of history, they would know that the biggest and worst mining boom in recent memory, possibly in the whole of history, took place from 2011 to 2015.
Mm-hmm.
And in that time, both of these companies were jacking up their dividends. You can see them on these charts. Now, in that time, these companies had what was called a progressive dividend policy, which meant that every year they would endeavour or had committed themselves to increasing the cents per share dividend that they were going to pay. And they were taking on debt in 2015 in order to maintain that dividend payment. Now, the cash flows were going to be strong enough. In hindsight, we know that. But the whole of the global financial industry ganged up on them and said, "You're idiots. You're taking on debt. Why the hell are you doing this? What a stupid thing to do. That's not sustainable." And, good argument at the time. And I think it was also correct in perpetuity to say that. So you see this fall off into 2016, where they both reset their dividend policies and at the same time showed the world that miners could be financially sensible and not just exciting commodity plays. And at that time, miners became cheap. All right. So I think those actions probably went a long way to turning the bust into the early stages of a boom. That wasn't the point of showing this chart, but to say that, dividends can be an interesting thing to look at. But I might also be disproving myself. So I say that margins are not going to expand, and here they are massively expanding their dividend. Well, let me go on just a bit. Here's an example from the Australian Bureau of Statistics, and it's exploration expenditure and mining capex. The yellow line is exploration expenditure. The brown line is mining capex, and these are in absolute dollars. So I haven't sort of reset them to a cycle start and given you a percentage increase. But if I did, you'd see a much bigger spike going into the late 90s. This spike probably wouldn't look as high. This one would probably look a bit higher. So they're cyclical peaks, right? So mining capex, what I want to show you here is that mining capex follows the same trends as mining exploration investment, as mining equities do. If I overlaid major indices on this, you'd see exactly the same trends. So the interesting thing to fall out of this particular chart is that mining capex has flattened. It's got 4 years of going nowhere in Australia, all right? So we take out of this big gas projects, big harbour developments, things like that were taking place in 2011, 2008. But, it doesn't matter if you go from one industry to another to say, oh, but they're not doing this time. Okay, we're going into a cycle boom, and we're in a cycle boom. Why isn't the capex flowing? Exploration is. Is that to say that exploration's taken off and capex hasn't? No, I think exploration is doing what it normally does. Capex has stayed relatively static. We're not seeing huge, big dollar figure investments, which are driven by those larger companies. And there's got to be a reason for that. And my reason for that, which is to say, the conclusion I'm getting to here is that margins don't usually expand that much with commodity prices. I think they're being allowed to.
Running out. I'm just letting you know, sorry, Hedley, we've only got a couple of minutes left. So
I'll make this quick then. I'll make this quick then. I think capex is being constrained here by the industry, particularly by the biggest spenders. Because if you think back to In the 90s, there was a mining crash, and then there was the dot-com boom and bust. And then we had the GFC and everything else that came along. And the most recent crime committed by an industry was the mining crash between 2011 to 2015. So if the teenagers are sitting around the table, and there's the tech teenager and the mining teenager, and the tech teenager wants to do something, and the mining teenager says, "Oh, you caused the dot-com boom." And then the parents just go apoplectic and go, "You idiots had not one but two massive tailings dam collapses. All right, you've been blowing up caves in the Pilbara. Get out." So expenditure is being overprinted by trying to be more responsible at the moment.
All right, we're final one. We got to be quick.
Cinderella's quick and easy. She's famous for two things. All right, she won the hand of the prince, but she was hopeless at keeping an eye on the time.
That's
just like me. The best way to map the mining cycle is to look at the number of IPOs. Here's an example from ASX. All right, we're creeping up now, and in fact, if I put on, there's all sorts of things to put on here, but let me just get to the end of this.
Let's go quick. All righty.
Okay. So 2011 IPOs are probably going to look like what we were looking like in 2011 and close to what we were in 2006 and 7. All right. We're getting up there. And when IPOs happen and big IPOs happen, we've seen 4 big IPOs this year on ASX for mining companies. We know liquidity is absolutely pumping. And you say, well, there's an enormous equity market boom going on. Yeah, good point. There usually is when mining booms are going on. So it's not one causes the other, they just go hand in hand. But you got to remember that booms lead to busts, always have and always will. And it's not that whatever the catalyst is at the top which causes the bust. A bust is caused by a boom and all the excesses which take place within the boom, not the catalyst. The catalyst is just what tips it. So there's money flowing in Canada as well. There's a great example there from the TSX, but we won't talk about that. Records being set.
Here's what I want to go with, Hedley. What's your final bit? Because before I have to cut you off, give me 3 things what people have to look for.
My final bit is that exploration is booming and it's pushing prices up in exploration companies. Got to be aware of that because people always pay far more for something that they don't understand than what they do. Margins are about to flatten again. BHP and Rio are starting to invest. Their 2020 numbers show that they did invest a lot more than 2019, and 2021 will be huge. And Cinderella almost missed the end of the ball because she forgot what time it was. In the market, we're now under the conditions that correspond with leading into the top of the boom. Now, it could be 2 or 3 years. I don't know how long it will be. And I'm not saying like Chicken Licken that the sky is about to fall. All I want to say is that if there is a catalyst now, we'll very likely see a lot of this liquidity in the mining space wash back out again, and we'll find ourselves in a bust, probably a short one, but it'll be particularly hard for exploration companies as that liquidity disappears. We're ripe for that. In between now and then, there's going to be some really exciting equity performances of those companies. So you've got to weigh one versus the other. I'm not saying don't do it. I'm just, I wouldn't be selling my house and putting in an exploration right now because we're waiting for midnight. We know it's coming. Cinderella knew it was coming, but her coach still turned into a pumpkin with her sitting in it.
And we've just hit midnight. Hedley Widdup from Lion Selection Group. Thank you so much for joining us at the Virtual Gold Conference.
My pleasure. Thank you very much for having me, Kerry, and nice to talk to you. Sorry for being so long-winded.